We all know that property advice is unregulated and myths abound around what makes a good investment. Most of these myths are nothing more than sales spin, yet many seem to have entered our national psyche, such as the rising tide lifting all ships one. If you enjoy challenging these myths as much as we do, then you'll love this episode because we've got evidence that a lot of what Australians believe about real estate investing is rubbish.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free Fool or Forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au.
Sometimes it takes an industry outsider to shed light on absurdities that insiders have become desensitised to. Today's guest is one such outsider who has taken a look at how property data, while readily available, is so misunderstood and misused to create weapons-grade bullshit. Oh, how I love that phrase. He's going to share with us his journey of discovery and reveal what the evidence says about successful property investing. Evan Thornley is a tech entrepreneur who has turned his attention to the real estate industry and, along with two partners, founded LongView, a firm focused on buying and managing residential property in response to the frustration they experienced with the short-term focus of the real estate industry in Australia. Music to our ears. Evan, thank you so much for joining us. We're very interested in digging into what you've learned from digging into the data.
No, thanks, Veronica. Yeah, look, thank you for having me. And thank you for that very kind introduction. I hope we deserve at least most of it, or we will in due course. You know, I'm from Silicon Valley, right? So you got to release the vaporware.
Let's
before
go there
the
first, to be honest, Evan. I don't usually like to go too deep on the whole life story and you tell us about your cats, etc. But what got you into the property market? 'Cause I do think it's an interesting twist to your story. In terms of a lot of tech stuff in the past, and now you've gone, let's work in the disrupt the property market. I guess what got you to sort of make that shift, and do you regret it, I guess?
I've never had more fun, actually. It's so strange. Look, I'm an old-time Silicon Valley person. I put the first Australian tech company on the NASDAQ 23 years ago. I think it was the first tech unicorn, as they're now commonly called, built it to a 14 billion market cap, which was, real money in those days. Delivered 100 times their money to our early venture capital investors and other things that you do in Silicon Valley. My PA paid cash for her house, actually, on the stock options in the business. So that part was particularly satisfying for her, I'm sure, as well as for us. I came out of that world and, came home to Australia. And I grew up on, in a single parent family on welfare and never had much money. So when you have some quickly, you then get very protective about not wanting to lose it. And so whilst I love building high tech and high risk businesses, I wanted somewhere safe to put my money. And like most sensible Australians, I felt that I was going to say bricks and mortar, but what I'll really say in a minute is dirt. But residential property was a good safe place to invest my money, and I went looking for help. And I guess I'll be honest. When you land on the rich list at the age of 38, there's a lot of people who'll give you a lot of advice on a lot of things. And I had very good lawyers and very good accountants and very good advisors on all sorts of things. And so I was assuming that don't you know who I am? Somebody come and tell me how residential property works. And there was no one. And worse than that, I thought, I'm pretty smart. I'll figure this out. Like most Australians, I thought I knew a lot more about property than I actually did. Really, I look back now and I realise how absolutely clueless I was, and in my case, arrogantly clueless, which is almost certainly worse, right?
What year are you talking here, Evan? Like what year roughly is it? 2002?
Oh, look, I came home in 2002. And gradually started, putting some money into resi property. I probably got more serious about that about a decade later. And, I actually had no idea what I was doing. And I thought, I thought I did. I didn't understand property finance. I didn't understand the way leverage worked. I didn't, just the most basic fundamental things which, land appreciates, buildings depreciate, right? Like I must use that phrase 10 times a day now with clients, with staff, with anyone who'll listen. No one tells us these things. It's just, and so it's only in retrospect that I understand that a lot of what I thought I knew was, I'm a reasonably well-read person, and I, kind of read the Fin Review and the quality journals, was actually a point of view either deliberately or unintentionally put forward by the three huge industries that surround this asset class: the mortgage lenders, the developers, and the real estate sales industry. And either through ignorance or malfeasance, they've educated us all with a load of weapons grade stuff.
Do you put the governments in there too, Evan? You've put the banks.
I'm doing it. Oh, definitely. Not so much governments, but the political argy-bargy, gets into all of that as well.
Did you learn a lot of hard truths, I guess, in that sort of 2000 to 2010, 2000 to 2010 period where you bought the wrong stuff and then you went, hang on a sec, this isn't working? Or
well, probably. I mean, in my case, probably more the next decade when I bought some stuff. But bought wrong stuff, both for personal homes and for investments. And I mean, it was random, right? Like some things did well, some things did badly, but absolutely zero correlation between what I might have thought and what actually would have happened. And I look back now on what I've both learned, as you were saying, Veronica, from experience, but also then from what the data tells me. And it's not that mysterious. At the margins, there are things that are hard to predict, but the central rules are incredibly clear. And so what is weird is not learning how this stuff works. What is weird is that is not commonplace, and indeed that the bulk of the narratives are driven either unintentionally or maliciously by a certain segment of the value chain, that being the banks, the developers, and the real estate sales industry.
It's interesting, and I hope you you will get to tell us very soon about how you got into the business side of the real estate industry. But it's interesting because we've come to very same conclusions, you and I, through different methods of research. And we're talking earlier, and we'll share with you listeners very shortly, that Evans used effectively machine learning and big, the benefit of your heritage at Silicon Valley and your ability to use technology to delve into data and work out what's really going on. Whereas I came at it from looking at case studies and scratching my head thinking, why did that one go up that much and that one didn't? Why did that happen if that didn't? Why did that person make money and that person lost money? How can it be that a rising tide does not lift all ships, that if you buy on a main road in a great suburb, you are not going to make the same rate of capital growth as something on a great street? All of that sort of started because I've got a natural curiosity, I guess, and I'm a critical thinker, that I'm scratching my head. And it took me a long time, I have to tell you. I started doing case studies and I started formulating my theories on this and thinking, why am I the only person that is seeing this? Am I missing something? I have to tell you, for me personally, it was actually a number of years where I'm thinking, I'm missing something. And I'm kept digging, thinking, what am I missing that everyone else seems to know? Then I actually started, and I was only reflecting on this morning, that we started this podcast 4 years ago. It was in April that we started recording 4 years ago. My learning through this podcast and the people that we've interviewed has actually helped me solidify and understand that I wasn't off the beaten track. Some things I had wrong. Some of my hypotheses were wrong. There's no doubt about that. I've learned so much. But you've come at it from completely outside the industry, and that's where you've come at it from such a different approach. I'm really curious to know when the light bulb went off for you and how and share, I guess, for our listeners what that light bulb has told you.
Yeah, thanks. Look, the first thing I want to make really clear, because this is completely central to who we are at LongView. Like, we are not a bunch of propeller heads sitting on a beanbag in Cremorne with black branded T-shirts, right? We're not your garden variety prop tech startup who thinks that everything can be solved by data algorithms. We do all that stuff for sure. I come from that world. But I think one of the central things that we've learned actually is that residential property can only be done properly with a combination of deep field expertise in the field, on the ground, with individual clients and individual properties, and the facts, so the data analytics. And the hard thing is to marry those two. And that's what we've been really trying to do as an organisation. Almost exactly, we've grown pretty quickly, I guess, the last few years. We're up to about 140 people now. And almost exactly half our organisation are long-term residential property. I don't like to use the word real estate because that sounds like sales agents, and I don't like sales agents. Are long-term residential property experts, and veterans of the industry, and about half our team are talented outsiders from a range of other industries that bring in new skills. And it's the chemistry of the two that I think has helped us bring a good set of answers, right? So my answer is not, hey, all our propeller heads got it right and you got it wrong, Veronica, but actually, we have, and the key thing to build a successful disruptor, by the way, in any industry is to get open-minded veterans from the industry with different skills from outside the industry and mutual respect between those two groups. And the hardest part is actually the last part, and we've really tried to do that. So we've learned an enormous amount from our team who have decades of experience serving clients in the trenches, doing the work, thinking about it afterwards, doing the type of things that, you I think, are a particularly analytical person in the industry, Veronica, so perhaps more than most, but all of that. But then bringing data science to look at it statistically. And part of it, Chris, I guess, just to kind of go to the client experience, this stuff really started, I can give you a bit of history on the company later if that's interesting to anyone, but, we started out in the property management side of the business just because that was done so badly and we felt so let down, and I'd never met a happy landlord. And once we started doing that really well, our client NPS scores at LongView are, like 70 NPS points above the industry average. I wandered off unsupervised with a spreadsheet and started analysing the investment performance of the properties that our clients had bought. They didn't buy them from us, and we didn't help them buy them, so it was nothing to do with us. And I was gobsmacked to see that on average, their capital growth performance was 280 basis points, 2.8% compound per annum, lower than the housing market average. So while our clients pay us about $11 million a year to do a really outstanding job of managing their properties, that same group of clients with that same set of assets is losing, not in cash terms, but in lost opportunity, $100 million a year in lost capital growth just to the housing market average, let alone if they had bought top half or top quartile or top decile assets. And that's when we said, boy, it's really important that properties are managed well, rental properties managed well, but there is no point, we are not going to make our clients successful as property investors if we don't help them buy well, because that's actually 90% of their end performance. And that's when we started working closely with some senior buyers advisors in the industry and trying to learn from them and work with them, and then bring data science into support, test the theories and the hypotheses and see what worked and what didn't. That was the genesis of it. It's just heartbreaking. You must see this all the time. Our clients are just mum and dad investors. They don't trust the stock market and all those other crooks. They work hard. They play by the rules. They put a bit of money aside and try and build, a safe and prosperous retirement and a little bit of money for the next generation. And they get sold a bill of goods by the developers and the sales agents. And the promise of all boats rising, as you say, Veronica, you must have had this yourself, all the time. They say, oh, gosh, I thought the market would have gone up by now, And you have to have that really heartbreaking conversation that says, actually, the market, broadly speaking, has gone up, but not for you, you know? And it's not gonna. And it made me really angry. Hence my uncharitable language.
It's interesting. So the property management industry, their product is, managing that property, right? And so it's heavily conflicted. Agents are always trying to attack their, property managed listings to try to get sales. and annoying the property management side, and then etc. But generally speaking, even property managers, they're not going to be saying, hey, I know if you bought a better investment property, you would have done better. A lot of them want to just keep that listing and keep the rental coming in, right? And not encourage them to sell because it reduces their book. But how are you sort of managing that when you've got, call it, thousands and thousands of investors that have got underperforming assets? How are you sort of encouraging them to, go back in time almost and start making decisions today on what they could do for their future, I guess?
It's really interesting, and it's a long journey with them because, look, we've been in the fortunate position, I guess, as, we called the company LongView for a reason.
Yeah.
We believe property is a long game, and we are in this business for the long term. And so, call us old-fashioned, but, like most quality professional services organisations, we absolutely live by the maxim that clients' interests are always paramount. And so we've been fortunate, I think, probably financially, to have the strength to be able to not be tempted to try and, have to get short-term benefits out of at our clients' expense. And so many has been the time where our clients have said, oh, look, we're thinking of, we want to sell the property. And we'd always say, but sure, we can help find someone. We largely don't sell because we don't want to be in that business. We think buying well is much more important than selling. But our first question is, why? What were you trying to achieve when you bought the property, or how did you, a lot of them are accidental landlords. What's happened now? Almost always is a change in either family circumstance or financial circumstance that leads to that. And we talk it through. And so often, and we have the conversation both ways. Other times we'll do a portfolio review with clients and we'll say, look, firstly, what were you trying to achieve in property investment? And have those objectives change. You get a lot of people moving towards retirement. They did invest, at least implicitly, for capital growth early on, but now they're needing more passive income. Okay, so the portfolio needs to change. But also each individual property. Is it a good property? Has it performed the way you want? And I think the most staggering thing to me, Chris, was, I did 50 depth interviews with clients, about 45 minutes a throw, early on in this process. And one of the most fascinating questions I asked them was, after I asked them why they bought the property and when, and was, how do you know if it's been a successful investment? What's your scorecard? What number do you look at?
Stumped.
And just like, how do you know? And I got one answer out of 50 that had some methodology that this was a serious investor who had a portfolio of 50 odd properties, and their answer, which I thought was a solid answer, was, well, if the capital growth of that property outperforms the suburb it was in. And I'm like, okay, that's a non-crazy answer. But honestly, nobody else gave me an answer that was an investor's answer. I know this is a good investment because it gets this level of return, or because and so it became clear to me that people don't necessarily know how to judge the performance of their property investments. And so, if you don't know where you're going, you probably won't get there.
Well, yeah, and I was about to say even that also a lot of people aren't game.
That's true.
Because the fact is, it's, and this is why 71% of property investors stop at one property in this country, is because they get in, they go, yeah, I've done it, and then it doesn't do anything for them. It doesn't help them, to actually increase their wealth by building a portfolio. And they're not game to admit they stuffed up because they don't know what the alternatives were. They no one talks about it.
There's no one to give them help, right? Yeah. And so, and a lot of my clients in that conversation, they kind of chuckle and they say,
yeah.
I really should have a good answer to that question, shouldn't I? And I'm like,
well, I mean, you've stumped them, to be honest, Evan. I mean, it's the question they don't really ever want to get asked, and because they know they don't have the answer to it. Even the one that did, I mean, I'd probably, wouldn't accept that answer. I think, because if that suburb grew at 1% and you grew up 2%, and the market grew at 7%.
Yeah, like I said, I thought that was an answer, right? And not look, on average, not a bad answer.
Starting point.
If I was marking the exam, it probably would have been a C+. So it's a lot of work, but this is part of the reason why I guess where LongView is going is towards more of a funds management approach, where we'll be looking to put together some larger scale funds where people can, I'd rather own 1% of 100 properties than 100% of one property.
So effectively like an ETF for properties.
Yeah,
Buy the market.
a real estate investment trust, right? Because firstly, we can then make sure that all the properties are well bought, that are not just top half, but hopefully top quartile or top decile. Secondly, it then gives diversity, obviously across a range of different markets and segments, because much as we all try and predict what might happen, the more prudent approach is to have at least a thoughtful diversity across states and across different city and regional markets. And thirdly, because then people will have liquidity. So, so many people, they say, oh, we need to sell a property. And I'll say, oh, well, why? This is actually a great property. This is your late mother's family home. It's 630 square metres in central Bentley in the McKinnon High School zone. This is your superannuation all day long. I wouldn't sell this one unless you had to. And you find out, oh, well, my sister needs to get some surgery and no one's got the money and I need 50 grand and so we're going to sell the property. And you're sort of like, oh, wow. You need to go talk to Chris. There's other ways to find that money, but they don't have liquidity, right? They don't, and so you've got this binary: I either sell the whole property or not. Obviously, it would be better if you could sell a portion of your units in a trust, or if you came into some extra money, buy some more units in a trust. So we do think in the longer term that creating those sorts of vehicles will allow mums and dads to invest in the thing they know and love and trust, which is bricks and mortar, or actually dirt. They think they love bricks and mortar, but in fact what they love is dirt, which is something we'll keep coming back to. But have liquidity, diversity, higher average return, and none of the management hassles of worrying about, gee, I can't afford the new water membrane in the
being
shower
a broker,
right
and an ex-financial advisor, I sort of go straight into the mindset of when would I have recommended that to clients in the past, and what are some of the challenges with that. And the reason they don't really exist, these residential, you got commercial big REITs, the Westfields and all that sort of stuff, but the reason that is firstly the leverage within the unit trust is really diminishes the returns over buying it personally. If you can leverage 100,000 10 times into an investment property. The second thing is that getting leverage within the trust is difficult because you've got to reduce it at LVRs. It's hard to then get leverage personally into a trust because the bank won't lend you another 80% on top of your money into the trust. But I mean, for people who are getting to that more end of life stage, who've got heaps of equity, they've got capacity, things like this do make sense, because they don't have to go and have a big lumpy asset in retirement. And so, I'm surprised we haven't got more residential trusts coming in.
Yeah, and I think, one of the things that surprised me, Chris, is how little leverage many of our clients have. So we always say that the single most important thing is which property you bought, and the second most important thing is how you choose to finance it. And most people don't have a clear way of thinking about either of those, and you would know that in both cases, right? And you'd see that all the time. So so at the level of leverage that most of the mums and dads have right now, you could replicate that level of leverage in a trust, and actually you could differentiate outcomes. There's ways of structuring that. So, but just on your question, as it turns out, the first of these investment vehicles we're putting together won't be for rental properties. It will be co-investing with young home buyers to get the deposit they need to buy their first home.
Let's
because that
jump
is the
into
crushing
that
social need right now, right? Like if you don't have the banker mum and dad, that's 1/3 of a generation that's basically locked out of the property market. And the irony of that is that it's like, I grew up on the Central Coast of New South Wales. I like the surf. It's like a big set comes through. You paddle really hard to get to the top of the wave. Either you get over it and you come all the way down and ride it into the shore, or you fall off the back and the next one's even harder to paddle over, right? So rising house prices are either your enemy or your friend, depending on whether you can get enough deposit to get on the wave.
So, Evan, on that, and I want to get back to investors, and I do.
Sorry.
No, but I want to just hit this first. I like that you brought this up. I want to get back to investors, and I think also, particularly, is an article that you were quoted on in the Herald some little while back, and we'll put the link in the show notes. And there was a very interesting chart there about capital growth, and I thought that was fascinating. So I do want to dig into that data.
Yes.
On the first home buyer thing, though. Obviously, the federal government came out just before the last election, and now we're recording this before, I'm not sure when we'll go to air, whether it would probably be before the election. With the 5% home loan guarantee, and that was pretty good in the sense that it did not limit first home buyers to have to buy brand new. And so then it gave them an opportunity to buy existing stock. But there were price caps, which is a shame, really, because that becomes a problem in itself. Then there's a bunch, you talk about prop tech, there's some prop tech solutions out there which absolutely make me want to rip my skin off. Like, honestly, makes my skin crawl. Some of those are absolutely, offering basically access to money. So first home buyers can get onto the ladder quicker, but the ladder that they're being incentivized to get onto or help to get onto is a rickety old thing. Well, it's not rickety old; it's brand new.
It's basically it's high cost second mortgage money.
Well, there's that, but there's also funded by developers to buy their stock.
We've seen that, for
so
sure.
That's another one. Combank has invested into one of them, which I can't remember the name of it. You can see that there's a massive industry all dying to get their greasy little paws on this, right? Even though really there's only 100,000 first home buyers in the market at any given time in Australia versus 11 million property owners. It's a massive trap to get first home buyers having that false sense of security that they're on the ladder. Yay, I made it. But then, then the nightmare begins. And I've been interviewing a lot of people from your first home buyer guide around this, and I've had some horrible stories. So I love the fact that you want to tackle that, but how can you not be one of those cynical, money grabbing, prop
100%.
techs or business people, whatever, thinking, right, I want a piece of this pie. Because it's an obvious problem, right? And when you've got an obvious problem, you've got everyone wanting to solve it and make their money out of it. And I really worry about this.
Yeah, look, and so do we, right? And I guess, again, our solution has come out of our client work. Again, not a bunch of prop tech kiddies sitting around with spreadsheets and investment bankers. So most of the solutions out there focus on selling you money, to your point, on some range of terms that may or may not be fair or egregious. None of them are serious about helping you buy the right asset, just for starters, right? So the first proposition that we have is the whole point of this is to help people buy a good asset. And as you know, Veronica, a good asset in the context in particular of an owner-occupied home is first and foremost a property that really meets the needs of the lifestyle of that family, and not just now, but over the next at least 7 to 10 years. And as you know, many young families can't see round corners. They buy the property that feels perfect for them today. Within 3 or 4 years, it's not going to work. They get smashed on a second set of stamps, yada, yada, yada.
Or they get divorced.
Sadly, they get divorced, or they buy a new Miele kitchen because it looks nice, but they don't recognise that the rest of the property is not valuable. So job one, there's no point in giving people finance to get on the property ladder if you don't help them get on the right rung of the property ladder. So I would separate us from almost everybody else in that space right now, because that's what we're doing. And a lot of the people moving into this space at the financial side are bankers at heart. Right? They come from that industry, right? And here's the thing about the three villains that I described earlier, right? The mortgage lenders, the developers, and the sales agents. Which out of any of those three give a rat's about what the property's worth, not today, but 10 years from now?
Agree.
Answer, none of them. Right? So, and that's why there's no, and those are the three big industries. They're the ones that have all the airtime. They're the ones that have all the political clout. They're the ones that buy all the advertising, so they get all the ink. and none of them have any interest, let alone knowledge, let alone care about what's the value of the property 10 years from now. And yet that's the thing that matters the most to the outcome for the people who buy that property, whether as an investment or as their family home. So, we start out as you do, Veronica, starting out as our job is to help the client buy a good property, all the more so if it's an owner-occupied home that works for them and their lifestyle and is going to be able to expand with their lifestyle sensibly if they need to, but which 10 years from now is going to get at least average performance, if not better. And so then a financing solution that helps them get on that wave, if it's fairly structured, will share a portion of the upside with them for helping do that and make sure there are no repayments and no cash flow drain along the way so they can't get themselves tipped over by borrowing too much money. It's an equity investment,
I think it's pretty smart, Evan.
So that's the way we're approaching it. And what was interesting to us actually was, as we researched this a lot with clients, we didn't know that the buyer's advisory component would be as valuable to them as it was. We thought they just wanted, just give me the money, just give me the check, I'll go. But actually, most of them knew that they didn't know what to buy or how to buy. And they thought that was important, and there was no one to help them. They kept saying, who's on my side? I know the bank's not on my side, right? I know the sales agents aren't on my side. They lie to me all day long. Maybe my mortgage broker's on my side. The good mortgage brokers, really are. Depends on their experience. The not so good mortgage brokers are more kind of paid operatives for the banks. So they think maybe my mortgage broker's on my side, maybe. But who's on my side and who's there to give me good advice? And so that turns out to be, and this is again,
I think you're bang on there, Evan. I think you're right. I've been consulted multiple times on new products that are coming into this space, privately around my thoughts on their products. And absolutely, the biggest risk is that they're trying to make money on the disadvantages of the first home buyer, right? By giving them the extra cash to potentially avoid lenders' mortgage insurance, or at least give them a 10% deposit and charging them exorbitant numbers that really wipe out a lot of their returns. But what they don't all get is it matters what the property they buy and whether that works for them, whether it goes up in value. None of them understand property market, right?
If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions, and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au.
Well, and this is what's ironic is, mate, they're going to deliver rubbish results to their own investors.
Yes.
That's what's ironic to me. Not only are you going to get poor results for your clients, which should bother you the most, but actually, the money tree and the venture money is going to run out sooner or later because you're going to get rubbish results,
especially
for the
going
investors
into a higher interest rate environment where potentially sideways movement with prices. You can't bank on property price growth, right? And especially on the type of properties they're looking at. I mean, I do always go back to the government, and the government have not really, pointed everyone in the right direction. The government have set a first home buyer savers deposit scheme, buying any property up to a certain price limit. That price limit is so low that it pushes you to poor assets.
And as you know, a lot of the state government schemes are then particularly focused on new build construction because really they're more subsidies for the development industry.
Sort of co-buy, there's a co-buy sort of talk in Victoria where the government owns a certain percentage of the property. All of these things are forgetting the big point which you raised. It all goes down to the property they buy at the end of the day. And I think if you can team
buy the right asset,
smart investors with good decisions for the first home buyer, they get their money back in time, but there's ways around it. Then there is definitely a sort of cross benefit there. So Evan, back onto your research and your data. When you've sort of gone and did you look at all the properties in Australia or just Victoria when you sort of analysed stuff? Okay.
Look, the first set of work we did was just all of Victoria.
What applies there will probably apply in different states. There definitely are different, changes to different markets.
There are. We're seeing, as we go through, but I mean, again, for convenience or ignorance, a lot of the traditional presentations of this data by, again, the banks and the other data houses, break things down by state or by, suburb often. And, we look at everything at the individual property level. We've analysed the sales history of every property for 50 years, right? Every transaction on every property. We always say to our clients, you don't buy a suburb, you buy a property. I can show you good and bad properties in every suburb in Australia, right? Obviously, some suburbs or groups or regions or cities or locations have certain points in a performance wave that are important to understand. But let me give you to take your case study methodology, Veronica. The data shows that one of the rules of thumb that our buying professionals always had was always buy in blue chip suburbs. You will always get better capital growth. And we tested that. And in the Victorian context, at least, that turned out not to be true recently. When many of them started in the business, that was very much true through the 80s and 90s and early 2000s. But the development frontier moved out from that point, and it turns out over the last 15 years, generally speaking, the capital growth performance in a range of middle ring areas had outperformed. So to take them, you'll forgive me using Melbourne examples, but Brighton, which is as blue chip as it gets, did an average 6.2% CAGR, compound annual growth rate, folks, and Glen Waverley did 8.1. Okay, so and even more interestingly, we colour coded the capital growth performance of every single property and stuck it up on a huge map. And gold was like 12% CAGR and above, so doubling every 7 years, right? Down to purple, which was sort of 3% or whatever. And there was this big golden triangle in the middle of the city of Monash, around the Glen Waverley area. And my team said, what on earth is that? Why is there all this gold? And you can look at it. And I said, actually, I know what that triangle is because I've just dealt with it in individual client assignments. That's the Glen Waverley Secondary College School District.
Is that the Chinese money?
Well, partly, yes. But what was interesting about that was it's not news, right, that a side street outperforms a main road. It's not news that, well, when I say outperforms, has a higher price, has a price premium. It's not news that a good school district has a price premium over being the other side of that road, right, and being outside the school district. That's a slightly separate question, though, as to whether they have a growth premium.
And in
this case, what was interesting about the Glen Waverley Secondary College School District is not that you paid a 15% premium to be inside the district than to be outside it. What was interesting is 15 years ago, you paid a 15% premium to be in the school district. Now you're paying a 40% premium. And so while Glen Waverley as a whole did 8.1% CAGR, the Glen Waverley Secondary College School District did 11.2. So absolutely shot the lights out. But so there I've used a bunch of data and it goes down the individual property level. But literally the same week we saw the golden triangle on the map, we did an appraisal for a client who owned a property inside the Glen Waverley Secondary College School District that they bought 10 years ago for $390,000. And guess what? We unfortunately appraised it for them.
Yeah, okay. Yeah.
285 down over that time, despite the fact that it was in like one of the hottest zones in the country, right? Why? It was a new build apartment that they paid too much for, and that was all building and no land content, and it went down in value over that period. So a complete train wreck. But I guarantee if I go back 10 years and I look at the developer's sales pitch, they would probably say, certainly if they had my data, buy this suburb, buy my development. It's in the hot suburb. It's got the greatest performance. Mm-hmm. And that's the stuff that I call weapons grade bullshit, because they use actual facts to mislead people,
100%.
And that's what really angers me. And that's why I go back to, you don't buy a suburb, you buy a property. Yes, the macro trends matter, and they do matter. And I talked about the middle ring versus the inner ring and a whole bunch of stuff. We do all of that, but the individual property.
I mean, most people get school zones, good school zones aligned to
going to be
income, higher incomes, because people want the best for their kids and they're working on their careers, and good public schools save you on the private school fee, etc. So the common sense sort of overlay does make sense.
Yeah.
What were some of the things where you thought?
But I want to just make the difference here. It's a subtle point, but a really important one. There are other school zones which have, say, a 20% price premium to be inside the school zone versus outside, but 15 years later, still have a 20% premium. So as an investment, you would be indifferent. I would still buy inside that school zone for a bunch of reasons, not least because on after-tax income basis, that's the cheapest way you can get an education for your kids by the length of the straight. And I think it's a good decision, and it's probably a nicer place to live. But let's be clear, from a financial point of view, if that price premium doesn't change, then financially you're indifferent. So we just try and make that distinction between price premiums and growth premiums.
Yeah, and this is really important because the growth premium compounds, whereas the price premium basically stays the same. And so that's where you get the gap widening over time between those that do well and those that are just sort of treading water versus those that aren't doing well. But why Glen Waverley then? Why that school versus others that are equally in demand?
Yeah, so obviously we're now working back through that, and we're now getting our team is correlating academic results by school and seeing if there's, how much you can track that and predict the impact that will have in future. There are also demographic issues there, as you mentioned, Chris. Yes, there is a significant, particularly Chinese language community there, as well as a significant Indian community in parts of that district, and there's particular income demographics and other factors that have probably played a role in that one.
As a question on that.
So as an investment, it slightly outperformed the McKinnon High School zone, which is arguably an even better school.
So with
it would still perform very well, by the way. But
does the diversity matter then? Because I know, like, one of the things I love with Kent Lardner's data is that price segmentation, looking at the diversity of price segments in any particular market. I would imagine, and I could be wrong about this, that Brighton in Melbourne, there on the Bayside there, would have maybe quite skewed towards the high end, maybe not a lot of the middle sort of, there might not be as many price segments perhaps. Is that something that Glen Waverley has that potentially the blue chip areas don't have or not? Chris is shaking his head.
Because in relative price terms, that was true 30 years ago, and Brighton outperformed Glen Waverley over that period. So, no, I think it's got more. I mean, yes, what you say is certainly true, and this is again the point, is using a single variable like location. It's about segmentation, but those segments could be location driven, they could be price point driven, they could be housing type driven, they could be a bunch of things. I think look, I'll give you the general thesis that is testing pretty well for us, and which again is sort of obvious, but which I think is reasonably robust in a lot of different situations. It comes back to this basic notion: land appreciates, buildings depreciate, and there's a whole lot of stuff, particularly around population growth, that is the fundamental long-term driver of that, not interest rates, by the way. And so part of what, the strongest correlation we see generally within the standard sort of urban areas of the three big cities to high capital growth performance is, and I use this phrase advisedly, land content. And what I mean by that specifically is what proportion of the purchase price you paid for that property was effectively the value of the land. And so generally speaking, our rough rule of thumb to start with is, if you're able to buy a property which has in excess of 80% land content, but is a solid older dwelling that is a good dwelling and that has plenty of useful life in it, and that perhaps ideally somebody renovated 10 or 15 or 20 years ago, so it gave you the good open plan back end and everything, the hard work had been done, but all that's been kind of, then you're highly likely to get strong capital growth performance. So in very simple terms, on average, if you see that well-located urban land, it appreciates about 9% compound per annum. On average, as the ATO will tell you, your buildings depreciate about 2.5% compound per annum. So it's a simple question: what proportion of my money is in the appreciating asset? What proportion's in the depreciating asset? The more subtle question is, which particular pieces of land are better located or will, on average, outperform other pieces of land? That's a less critical question, but it matters. And it comes to the Glen Waverley versus Brighton examples that we've used here. The key thing that seemed to drive land value appreciation is what we call the development frontier. So essentially when the developers started coming through, buying up the quarter-acre lots and cutting them up into townhouses and villas, that's when a super premium was paid for those blocks of land. And you can see, if you watch a colour-coded map over a 30-year period, you can watch the development wave roll out across the city.
But that's a one-off. That change of zoning is a one-off hit, lovely sugar hit for whoever happened to sit on that property.
These weren't necessarily changes of zoning, though. I mean, you'll see specific zone change are much more dramatic, and as you know, that's much more micro-located. But it's a general change of land use, I guess. And so that's broadly, I think, why the houses in Glen Waverley outperformed the houses in Brighton over that period, is that there was substantial redevelopment of those properties at that time. And we're seeing that wave moving now more to the middle outer suburbs. And as you would be unsurprised to know, there's a very strong correlation around particularly access to train stations within those bands.
So does that then mean that once that wave is gone, then it comes back is there a second wave? It starts again, or does it come back to your blue chip areas, then start to actually outperform again? Because once that one hit of the zoning change, the redevelopment change.
Well, I guess this is what I'm saying about this is a second order effect. Which land appreciates slightly better than other land? The primary order effect is ensuring that you've got good land content, right? And broadly speaking, well-located land across a large part of the urban mass is, on the long term, appreciating about 9% compound per annum. But some of it does 6 or 7 for a period and then does 10 or 12 for a period. If you can understand or time some of those waves, and, the development frontier is one of them, obviously new infrastructure or other things comes in, or new school zones, or, all the other factors we all know, and Kent does wonderful work on. That stuff not at the margins, it ends up being material, but the land content thing is still the number one driver, and it's still the thing that's least understood by ordinary property buyers.
So when you're doing the data, we've always got beliefs, right? Things that we think are true until the data sort of proves us wrong, right? Was there certain things that popped out where you thought, that there should be a bigger premium that people are, a better capital growth return they're getting for that benefit, but the data sort of shows that's not the case? Is there any sort of really surprising things that...
Well, let me tell you, look, my favourite mythbuster, and this is not at the individual property level, and there's a whole bunch of segments where it matters, but my favourite mythbuster, just to call complete bullshit on almost the entire dialogue around property prices for the last 5 years, is the issue of interest rates. Here's a simple exercise. Map interest rates in Australia for 100 years and map property prices and capital growth over the same period and put the two graphs together. If the understanding that is widely put out there that property prices move in inverse correlation to interest rates were true, you would see that on the graph. You don't see that at all. You see a very muddy correlation that on average statistically is in fact slightly on average in the opposite direction. Now, I'm not saying that if interest rates go up tomorrow, property prices won't go down. But what I'm saying is it's a much more complex equation. And a lot of it has to do with it's a love triangle of 3 variables, not 2, because the third variable is inflation. And of course, interest rates are put up in response to inflation, but property prices go up with inflation. And for those who are highly levered, as you know, Chris, inflation is your friend, right? Because it diminishes the relative value of the debt versus the equity on the property. And so the simplistic understanding of the correlation between interest rates and property prices is just not true. It's much more complex. And as to your point about, segments, of course, there are highly interest rate sensitive segments, just as there, as the politicians will talk about the mortgage belt, they're highly interest rate sensitive voting groups. There are highly interest rate sensitive segments, which are very highly geared segments of the market, and they do have a bigger correlation, they have a more serious. But so to me, that's just a good example of stuff that is just accepted without question. And literally, the first time I did this, it takes less than 120 seconds on Google to get those two graphs and put them together and go, wait, hang on a minute. that didn't show what I thought it was.
Stuart Weems did a podcast on this only very recently, and he put a chart up. And in fact, I ran a masterclass for my clients last night on basically, should I sell my investment property now? A lot of people going, oh, it's the peak of the wave, I should be getting out. I'm like, hang on a minute. And look, the things you were saying earlier, Evan, asking exactly those same questions. How does this fit with what your original plan is? Did you have an original plan? Like, how has it performed? How are you measuring that? How are you benchmarking? I'll put money on that you're not, all that sort of stuff, right? So, and I brought up that chart.
And there's this whole focus on the right time, right? Oh. And the focus should be on the right property.
Exactly.
Right? That right time thing, again, comes from other industries, right? I mean, it partly comes from the share market, right, where trading really matters, but it also comes from aforementioned villains, okay? All the other villains in the piece, mortgage lenders, developers, and sales agents make money on transactions.
So
what's the right time according to them?
Now.
Today is always the right time. Now is always the right time. The question you should be asking is, what's the right time to do something? And the answer is always today, right?
So Evan,
the question should be, what's the right property?
Just on that, right? And obviously the timing is more important when you sell than when you buy, I do believe, because it does come back to the right asset, right? And if you've got a shit asset, you should just get rid of it. But so I looked at that correlation. Interesting. I had a chat with Stuart about that as well, and he sent me a tweet from the Steve Kukanidis. We have interviewed him some time back. He said the same thing. When will these economists start looking at the evidence and stop saying that prices fall when interest rates rise? Then I was listening to a podcast, a CommBank podcast, where Gareth Aird, the chief economist of CommBank, said prices will fall, interest rates will be rising, prices will fall. And I'm like, this is just absolutely, I think it's just laziness for someone in his position to actually say that.
But again, and in this case, I don't think the major retail banks are deliberately trying to mislead people, as I dislike them for a whole range of reasons. It's just because they live in an interest rate-driven world and their profits are driven by interest rates and the spreads they get on that and a whole bunch of other stuff. They just assume this is true in the same way as, the development lobby says the reason house prices keep going up is because there's not enough supply. Now, that, again, no, that's not true. The reason rents don't go up is if you don't have enough dwellings. That's true. If the supply of dwellings is slower than the supply of people who want to rent them, then rents will rise. But as it turns out, what's driving house prices up is not the supply of dwellings, it's the supply of land and the fact that it never changes and the amount of demand for that land. And so freeing things up for more development will, of course, put upward pressure on land prices, not downward pressure. I'm not saying we shouldn't have more development, there shouldn't be more supply, and that isn't critical to affordable housing, but let's at least
be honest.
Be honest.
I think your interest rate one is very true, because there's people, I guess, level one thinking. They think, rates go down, prices go up. So the next 3 years, rates are going to go up. So prices are going to go down. So why would I buy it today? I'll wait till rates go up. And they think, and then they apply that logic to the whole market and they go, well, why would I even buy in 2022? And they forget that. Yeah.
And Chris, people have been sold that bill of goods for, Steve Keen, how many decades have we met people who said, I'll stay out of the market? And so, let's be clear about the one thing, Australian house prices and urban land prices have gone pretty straight north for 100 plus years now. And what are the variables that have consistently correlated with that? It's not interest rates. It's not negative gearing or any other tax policy. It's not supply.
I know what you're going to say.
Right.
Inflation.
Population.
Australia has no. Inflation up and down. Two things. Australia has close to the highest population growth rate in the world, and has had since before we were born.
Income growth.
And Australia, New Zealand, and Israel have the three highest population growth rates in the world. Apart from sub-Saharan Africa, of the developed world, right? And secondly, uniquely in Australia, we have the highest urban concentration. 52% of our population is in just 3 urban centres, Sydney, Melbourne and South East Queensland. So, in the US, for example, which has quite high population growth, but not as high as us, the top 20 urban centres only make up 39% of the population. If it gets too expensive in Philadelphia, you move to Baltimore, and that's just fine. Right? In Australia, you simply don't.
You move to Brisbane.
So... right? If you have the close to the highest population growth rate in the world and close to the highest population concentration in the world, and you have a stable, well-run and well-regulated macroeconomy, which actually we do, which is ironed out. Everyone says, there's going to be this is a housing boom, there's going to be another crash. It's interesting muscle memory. There hasn't been a crash in Australian property since 1893. They're talking about the UK, the US, a bunch of other markets that were not well regulated. Ours was, right? So if you have those characteristics on average, there'll be wrinkles year by year, but on average, you're going to see that continued increase in the value of urban land. And so, that's the fundamental thing. It's not complete. It's not one variable that drives everything. Look, we've just gone through a lack of population growth and yet prices have gone through the roof. I get it. But over the long term, the principal driver of Australian housing prices has been increasing population with stable to increasing population concentration. And that's driven land values, and that's
growing our economy in terms of companies and the wealth and the capitalism and the incomes to a certain pocket leads to and then a lack of zoning changes on top of that. But ultimately, I see what you're saying. I mean, the interesting thing is that a lot of people will take that level on thinking, I'm not going to buy because prices are going to fall, because they read the CBA article or they listen to Steve Keen or Martin North or something like that, right? Martin and I are good mates. But you know what I mean? They don't really then understand the dynamics of the local market, all that art that you spoke about, Well, if prices are falling, then people are less likely to sell. And so, because they say, well, why would I sell in 2022? And then, exactly. And then people sit on their hands, and then it's actually harder to buy in down markets. And when that good property comes up, all the buyers are picky, go and try to buy that good property. And then it's like a fight, like a seagull over a chip. And so I think you're so right. I think that, most people are focusing on what the world's doing and not focusing on the asset they're buying and how does that fit their long-term plan.
Yeah. And try and have these simple rules of thumb and one size fits all and single variables, which don't work, right? I mean, the price segmentation, what drives price performance in the more luxury ends of the markets is actually more the performance of equity markets, right? Right. Those folks are making big money on the stock exchange, and when they make big money on the stock exchange, it all drains down into real estate, right? Henry George was right 140 years ago. Long term, land becomes the wealth sink of every economy.
And I think you've got to believe in the big picture, Australia. I think that, there's a lot of people who think we shouldn't, grow our population, but the reality is 25 million in, 8, 9, 10 billion people in the world over the next, 50 years. So we're going to grow our population, right? It brings in so much money to our economy, and we want to grow our economy and standard of living. So if you believe in that, then you've got to believe in sort of good quality land in our capital cities, because we can't just build another Brisbane or a Sydney or a Melbourne overnight, right? Like those things take decades and decades, and we're sort of already behind the eighth ball because we're moving to more knowledge work rather than sort of farmland, I guess. Yeah. So at one level, I think that the broad trends are actually pretty simple and pretty uncomplicated and pretty incontrovertible, which is why taking advice on don't buy because prices are about to go down generally is that's not the right. You're asking the wrong question. Well, the right question is what property should I buy? A secondary question may be, is today a really bad time to buy this property? Because occasionally you might say it's not the best time. But absent that, if you have good objectives, you're buying for the long term. And again, look, we've analysed after about 7 years, what we call the vintage risk becomes much less significant, right? So different bottles of wine from different vintages are better or worse, and it's the same with property prices in different segments. And so obviously there are some years that it would have been a better year to buy in, broadly speaking, than others. But after 7 years, those effects have mitigated to a significant extent. By 12 years, it's really, there's just not a lot in it. So the important thing again was, did you buy the right property?
I've done some analysis on that as well, and the premium you may have paid on an A-grade asset, an A-grade location, actually that premium doesn't compound. It's a one-off cost. and it sits there, like you say, and the longer you own that property, it just diminishes in percentage and impact. And
as does your stamps, right? And which is yet another reason why, you should be buying for long-term hold wherever possible.
Yeah.
And therefore you've got to buy the right asset.
Exactly. The other thing too is that, there's a lot of noise around interest rates and falling prices and all the rest of it. And it's not helped by the fact that the media can't actually, interpret numbers. One is, and I mentioned this in the Fuller Forecaster Report episode, and I was really surprised that Westpac came out with this forecast saying that 14% price falls by 2023 or whatever. And it literally, this was released at the end of the last half of 2021. They were saying another 2% rise at the end of 2021 and a fall of, I think, 5% 2022 and a 7% in 2023. Now, if you add those three numbers up, you get 14%, but it's actually +2, -7, -5. It's 8%. So, the point is that was just repeated as headlines and people go, 14%. And it's like no one even bothered to interrogate actually what compromised that.
Well,
but
and again,
another one, though, is the RBA saying that, if interest rates rise, then the growth rate will be, price growth will be impacted to the tune it will be 15% lower than it would be in 2 years' time if interest rates don't rise. So people go, oh, my God, prices are going to fall 15%. No, they're not. What they're saying is that prices won't grow, quite as much as they will if interest rates stay as they are, and it's once again, it's like stop reading a bloody percentage and the word fall or not price rise or whatever, and then just go, oh my God, it's all going to fall off a cliff. It's actually not. Read the detail, understand it.
Yeah. And look, I suspect that there will be some price falls in our market.
Yeah.
With or without interest rate changes, quite frankly, because it's just gone through the most rapid price increase in history, right? But the reverse was also true. Everyone was going crazy about the uptick that started in the middle of COVID when everyone thought it was going to be a downtick. And the first 12% of that uptick was just catching back up to the peak of 2017. So, it was only the second half of that was even new growth, right? So people always look at an incredibly short time frame on property prices and try and explain everything in that incredibly short time frame. And you just zoom out and look at the picture over a decade or more. And
it's an interesting point, actually. I mean, at that COVID point,
how much ink
I actually was chasing up old clients, clients who are interested in sort of doing something, and they go cold because, they read the wrong things, etc. And this one client was going to buy an investment property. He goes, and it was April 2020, and he said, I think prices are going to fall, blah, blah, blah. And I just quickly wrote one paragraph back to him and sort of said, it's not what we're saying, it's not what we're seeing on the ground. We're seeing demand pick up. We're seeing more applications for pre-approval. We're seeing sellers, listings start to drop. And when you started to apply that, obviously there was a real peak time of fear. And we were like, and then you exactly. So what people think is going to miraculously happen. Then you got to get on the ground and see what's happening. From listings and buyers, etc. And it's really Evan. Have you got a property dumbo for us?
But again, all this focus on timing in the narrative is driven by the transaction-driven industries.
Yeah, I agree. This is what the state government is, trying to do is create more transactions, right? They make more money on transactions, and they're trying to move from stamp duty, which is ineffective, to land tax. And there's research out there that even said they reckon transactions are going to increase 50%. If you increase the speed of the property market, you increase the speed of debt creation. And if you can create more debt, you'll create higher prices. And that's exactly what. So you'll allow more people to borrow because they don't need stamp duty. They need a 10% deposit. So that'll create short-term increase in demand. But then when they buy something of someone else, then they'll reinvest and they'll take out more debt, and the whole system kicks off. Hence why they're always trying to keep first-home buyers into the system to keep on creating more debt. So, it is absolutely. It's all about transactions, and people forget that higher transactions correlate to higher prices because more debt. Evan, have you got a property dumbo for us? So a story, it doesn't have to be yourself, someone or maybe one of your clients, that a mistake that we can all learn from.
The last thing I want to do is label this client a dumbo.
Yeah, it's a bit of a play on words with our elephant. Yeah,
honest. But
we don't think people are dumbos.
But again, they were tricked. Okay, so we have a lovely family clients of ours, hardworking folks. He's a tradie. She's a teacher or a nurse. I forget which. She'll forgive me. they own, a solid working class home in Altona Meadows, which is a modest Western Suburbs family suburb. They worked hard, put money aside, saved some money, wanted to make sure they had a little bit to hand on to their 2 daughters who were in high school. They bought 2 investment properties as a consequence. They bought 2 off-the-plan apartments in downtown Melbourne. And they came to us and said, look, we really want to move to central Altona, which is much nicer, closer to the beach, on the railway line, and the school there is really good, but we're just not sure we can afford it. And I said, and we looked at their whole situation, and I said, well, actually, the single best thing you could do is to sell those 2 non-performing apartments and put all of that money, I know this is very tough advice for me to give you, buy yourself a nicer house. And they didn't trust my advice because it was so, and I said, if you sold those 2 properties, you could buy a lovely period home in central Altona, close to the railway line, in the school, close to the beach. You will get, 7 or 8% capital growth on that for the next 15 years. It'll be tax-free. It'll be land tax-free. It'll be capital gains tax-free. You will have more to hand over to your daughters than the hard-working, honest effort you've made to sacrifice your personal lifestyle in order to buy these investment properties that you were tricked into buying. And it made my heart break to see people led down that path. And we see it
I literally just jumped off a call at 1:30 today prior to this, and it was a similar situation. Perth, we don't do many clients in Perth, to be honest. It was, and they wanted to buy a really modest home in Perth, around 600,000, and his belief was he'll buy that and then he'll go and buy an investment property. And roughly you could buy a $600,000 house and a $600,000 investment property, or maybe $1 million house, right? Because he doesn't get the rent on the investment property, right? And I'm like, well, where's your $600,000 house going to be? It's not going to be in the desirable parts of Perth. Where's your $600,000 investment property again? Not going to be a quality asset, right? It's tough at that price point. And, it was just didn't understand the opportunity cost of potentially just going down the home route with one better asset growing tax-free, and just really wanted the validation to me to say, yeah, okay, I'll do the loan. And we're like, well, no, it's not how it works.
Yeah. Yeah, because people sold a bill of goods, not least by property spruikers and other villains. That the number of properties.
Absolutely. And so he's saying, well, I need a retirement income. No, you just want to build net asset base. They'll give you retirement income in the future. And it's all these sort of myths that unfortunately they just, if you go and you speak to someone, they're just going to validate you. See, it was easy for you, Evan, to say, okay, probably you can't afford it. We'll just keep managing those 2 investment properties. What you do is you lift the veil up, and then they're like, then they've got to make hard decisions, the sunk costs, the loss aversion, the feeling that they've made mistakes all sort of come to fruition. And but ultimately, you and I both know that would have been the better decision. It's just that you got to have the confidence to deliver it, knowing that it might upset them, but knowing it's ultimately what they need to hear.
But this is why, and I've talked to Veronica about this. This is why the buying industry needs to become a loud voice. And a unified voice.
Well,
the quality buyers, I know there are transaction-driven buy-side folks as well, as we know, and they're not going to be. But for the quality part of the buying industry to develop its voice and say, our profession is about ensuring you buy properties that meet your needs today and in the future, and will be worth significantly more 10 years from now than they are today. That's what we're focused on. It's about individual properties, not the whole property market. And those are the questions you should be asking. What am I trying to achieve, and what's the best property to help me achieve that now, and how can I buy that property? And if we can just get those simple messages out consistently into the public square, we'll have done.
Awesome, Evan. I think that's a great way to end it, to be honest. And really appreciate you coming on and spending some time with us. So thanks a lot, Evan.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a dumbo.